The 40-year cycle of gold and financial reset gold has always held a unique position in the world of finance. For thousands of years, it has been the standard by which the value of currencies and wealth has been measured. Unlike fiat currencies, which are issued by governments and can be manipulated or inflated, gold has maintained its value through all manner of political and economic upheaval. Gold's place in the financial world is unparalleled. Its movements and cycles provide invaluable insights into the stability of the global economy. While many people look at gold prices and see only short-term fluctuations, there is a deeper and more predictable pattern that underlies its movements. Gold follows a cycle one that repeats roughly every 40 years. This isn't just a random occurrence or coincidence. It's a financial inevitability rooted in the cyclical nature of debt, inflation, and government intervention. By examining this cycle, we can understand not only gold's price history, but also the financial events that have shaped the global economy. To fully understand gold's movements, it's essential to look at the critical moments in history that have defined its price. These pivotal points have occurred every 40 years, roughly speaking, as a result of debt cycles that inevitably reach a breaking point. When the financial system becomes overloaded with debt, a reset occurs, and the global economy is forced to adapt. Let's go back in time and look at some of these critical moments in the 40-year cycle and see how gold's role has evolved. The Great Depression and the gold confiscation of 1933. The first major reset in modern financial history occurred during the Great Depression, which began in 1929 and stretched into the early 1930s. The United States, and much of the world, was in the grips of one of the worst economic crises in modern history. Unemployment rates soared, businesses shuttered, and banks failed at an unprecedented rate. The entire financial system was on the brink of collapse. For many Americans, gold was seen as the only safe haven during this economic turmoil. People understood that gold held real value, far beyond the reach of failing banks and collapsing paper currencies. However, this posed a significant problem for the U.S. government and the Federal Reserve. The government, which was already burdened with immense debt from World War I and domestic spending, was unable to print enough paper money to stimulate the economy and support the government's obligations. The Federal Reserve could not increase the money supply because too much gold was held in private hands, and this limited its ability to issue more currency. The government needed to seize control of gold in order to have full flexibility in managing the economy. In a desperate attempt to address the economic crisis and restore financial stability, President Franklin D. Roosevelt signed Executive Order 6102 on April 5, 1933. This executive order made it illegal for American citizens to own gold, with the exception of certain allowances for jewelry and collector items. Citizens were ordered to turn in their gold coins, gold bullion, and gold certificates to the Federal Reserve in exchange for paper currency. The price offered by the government was $20.67 per ounce of gold. At first glance, this might seem like a strange move. Gold had always been seen as a safe haven in times of financial turmoil, and many people had accumulated gold in the hope of protecting their wealth. But for the U.S. government, the hoarding of gold posed a significant obstacle to the broader goal of managing the economy. Gold represented the old financial system, one in which the dollar was tied to a fixed amount of precious metal. In order to maintain control over the money supply, the government needed to sever this link and increase the amount of paper money in circulation. So Roosevelt and the government effectively confiscated the wealth of American citizens and forced them to exchange their gold for paper dollars. Those who refused to comply faced severe penalties, including heavy fines and even imprisonment. At the time, this move was justified as a patriotic duty to stabilize the economy, but it was also a massive wealth transfer from individuals to the government. The real theft came later when, in 1934, the U.S. government raised the official price of gold to $35 per ounce through the Gold Reserve Act. In essence, the government had just taken the gold from citizens at a fixed price of $20.67 per ounce, only to revalue it at $35 an ounce. This was a 69% increase in the price of gold, which in turn devalued the U.S. dollar. This act marked the first significant shift in the financial system. The government had used its control over gold to revalue the dollar, turning a potential crisis into a profit. The collapse of the Bretton Woods system and the Nixon shock fast forward 40 years, and we find ourselves in another critical juncture in the financial system. By 1971, the global financial system was facing a different set of challenges. After World War II, the Bretton Woods Agreement was established to create a new global financial order. The US dollar was pegged to gold, and other currencies were tied to the US dollar. This system established the dollar as the world's reserve currency, and countries could exchange their dollars for gold at a fixed rate of $35 per ounce. The system worked for a time, but by the 1960s, the US government had accumulated massive debts due to the cost of the Vietnam War and social welfare programs like the Great Society. To finance these costs, the US government printed more dollars, far exceeding the amount of gold in reserve. As a result, countries around the world began to realize that the US had overextended itself. Foreign governments started to demand gold in exchange for their dollars, and US gold reserves began to shrink rapidly. By 1971, the situation had become critical. The US was facing a gold drain, and the Federal Reserve no longer had the gold reserves to cover all the dollars in circulation. In a dramatic move, President Richard Nixon announced on August 15, 1971, that the US would suspend the convertibility of the dollar into gold. This marked the end of the Bretton Woods system and the beginning of the era of fiat, currency that is not backed by any physical commodity, but rather by the government's promise. Nixon's speech, though technical and bureaucratic, had profound implications for the global financial system. He stated that the suspension would be temporary, but as history has shown, it was far from temporary. The Nixon shock led to a fundamental change in how global currencies operated. The US dollar was no longer tied to any real asset, and its value was subject to the whims of government policies and central bank actions. This move set the stage for years of inflation, currency devaluation, and increased government spending. Gold's role in the 1970s crisis and the 1980s recovery. With the US dollar no longer tied to gold, inflation began to rise rapidly. In the 1970s, the world experienced a period of extreme economic volatility, with inflation rates reaching levels not seen since the Great Depression. As the dollar weakened, the price of gold began to surge. By 1980, the price of gold reached an all-time high of $850 per ounce, a dramatic increase from the $35 per ounce it had been pegged at just a decade earlier. For those who held gold, the 1970s were a period of massive wealth preservation. The price of gold skyrocketed, and those who had bought gold in the early 1970s found that their investments had increased in value significantly. On the other hand, those who held paper currencies like the US dollar found their purchasing power severely eroded by inflation. However, by the early 1980s, the Federal Reserve, under the leadership of Chairman Paul Volcker, took aggressive steps to curb inflation. Volcker raised interest rates to nearly 20%, a policy that successfully tamed inflation but also caused a severe recession. The gold market, which had been thriving in the 1970s, began to stabilize. The price of gold fell from its 1980 peak, and the global financial system appeared to regain some stability. This marked the end of the second major phase in the gold cycle, as the financial system adjusted to the new era of fiat currency. The 2008 financial crisis and the role of gold. Jump ahead another 40 years and we find ourselves in the midst of the 2008 financial crisis. By this time, global debt had reached unsustainable levels, and the financial system was once again on the brink of collapse. The crisis revealed the inherent flaws in the global financial system, particularly the over-reliance on credit and debt. In response to the crisis, the Federal Reserve and other central banks around the world implemented quantitative easing, a policy of printing money to buy government bonds and other assets in an attempt to stabilize the financial system. The goal was to flood the market with liquidity, but the result was an accelerated devaluation of the currency. As inflation expectations rose, gold began to rise again. By 2011, gold reached another record high of $1,921 per ounce. This was not just a reaction to inflation, it was a clear signal that investors were losing faith in paper currencies and seeking the stability of gold. Central banks and institutional investors around the world were increasingly turning to gold as a hedge against inflation and the growing uncertainty in global markets. The rise of gold and the shift towards financial transformation as we journey into the future. We must recognize that the world is facing a financial system at a breaking point. The cyclical nature of the global economy, particularly in relation to gold, has played a critical role in shaping how nations respond to mounting debt crises. Understanding the patterns from past resets can offer profound insights into where we are headed in the next phase of the 40-year cycle. In Part 1, we discuss the significant events in history, such as the 1933 gold confiscation during the Great Depression, the Nixon shock of 1971, and the 2008 financial crisis, which all contributed to the evolution of gold's role in global finance. These events, spaced roughly 40 years apart, serve as markers in the gold cycle, indicating that the financial system resets at regular intervals, usually when debt becomes unmanageable, inflation takes hold, and a new structure is needed to stabilize the economy. Now, as we look ahead to 2026 and beyond, it is clear that we are entering the most volatile phase of this cycle. There are clear signs that the upcoming reset will be more impactful than anything we've witnessed in the past. This will not be just another market fluctuation or crisis. This is shaping up to be a comprehensive and transformational shift in the global financial system, much like the ones in 1933, 1971, and 2008, but with even more significant consequences. The growing debt crisis, the most alarming signal. Today, the U.S. national debt has surpassed $38 trillion, a staggering figure that reflects a system at its breaking point. In 1980, the national debt was roughly $900 billion. By 1990, it had reached $3 trillion. In 2000, the figure was just under $6 trillion. The explosive growth over the past few decades signals an unsustainable trajectory, one that echoes the patterns of past cycles. The U.S. government's massive debt load is already consuming a significant portion of its budget. In 2026, the U.S. will likely spend over $1 trillion annually just on interest payments alone. This is a serious problem. For comparison, this amount exceeds the entire U.S. defense budget. The government's reliance on borrowing to service the debt creates a dangerous feedback loop known as fiscal dominance. This occurs when the government borrows more money just to meet the interest payments on existing debt, which only deepens the crisis. As borrowing continues to increase, the interest burden becomes so heavy that the government's ability to maintain fiscal policies becomes severely compromised. With mounting debt and rising interest rates, the U.S. is now faced with a scenario where the interest payments will consume more and more of the national budget. This leaves less room for other critical expenditures, such as infrastructure, healthcare, education, and social security. The only way to escape this cycle is either through default or by printing more money, essentially inflating away the debt. Both of these options are fraught with dangers. Inflation and the erosion of purchasing power. As we approach 2026, the primary threat facing the U.S. economy is the rapid devaluation of the dollar. Inflation, which had been relatively low for decades, is now surging at levels not seen since the 1970s. The cost of living is increasing dramatically, while wages remain stagnant for many working-class families. As the dollar loses its purchasing power, people are feeling the squeeze. Gasoline prices, groceries, and housing costs have all skyrocketed, while wages have not kept pace. The middle class, once the backbone of the U.S. economy, is being squeezed out. Inflation is eating away at the wealth of ordinary Americans, while the wealthiest continue to protect their assets by investing in real, tangible assets, primarily gold, real estate, and other hard assets. This growing wealth inequality is exacerbated by the financial system's dependence on debt, and the average American is finding it increasingly difficult to maintain their standard of living. One of the most alarming developments is the depreciation of the U.S. dollar. Once, the dollar was the world's reserve currency, trusted by governments and institutions around the world. But now, many countries are losing faith in the U.S. dollar's stability. The recent surge in inflation, combined with the ever-growing U.S. national debt, is causing nations to seek alternatives to the dollar. The dollar's devaluation is a signal that the system is unraveling. When a currency begins to lose value, people typically look for alternatives to preserve their wealth. Historically, gold has been that alternative. Gold as the ultimate hedge against currency devaluation. Gold has long been seen as a hedge against inflation and a safe haven in times of economic instability. When fiat currencies lose value, investors flock to gold as a tangible asset with intrinsic value. Unlike paper money, which can be printed endlessly, gold is finite and its value is based on physical properties, not government promises. The recent surge in gold prices is a clear signal that investors are losing confidence in the dollar. As inflation continues to erode the value of fiat currencies, gold is becoming increasingly attractive. Central banks, which were once content to hold paper assets, are now buying gold in large quantities, signaling that they see the writing on the wall. The World Gold Council reported that in 2022 and 2023, central banks purchased more gold than at any time since 1967, the year before the Bretton Woods system collapsed. This buying spree is not just for investment purposes. It's a sign that central banks are preparing for a future where gold plays a more central role in the global monetary system. The fact that central banks are diversifying away from the US dollar and into gold is one of the clearest indicators that the dollar's dominance is in jeopardy. As the global monetary system shifts, gold is emerging as the ultimate store of value. The rise of de-dollarization and the end of US dollar dominance. For the past several decades, the US dollar has been the world's reserve currency, meaning it was used for international trade, savings, and as the standard for global finance. But in recent years, there has been a growing movement towards de-dollarization. Countries like China, Russia, Turkey, India, and others are increasingly choosing to settle trade deals in their own currencies rather than using the US dollar. This trend is a direct challenge to the dollar's dominance in global markets. In particular, China has been aggressively moving away from the US dollar. The country has been purchasing gold at an alarming rate and has been actively promoting the use of its own currency, the yuan, in international trade. China has also sought to create a gold-backed currency as part of its broader strategy to position itself as a major player in the global financial system. As nations move away from the US dollar, they are turning to alternative assets like gold. The use of gold as a store of value and a medium for international transactions is poised to increase, and this could mark the end of the dollar's reign as the world's reserve currency. This shift will have profound implications for global trade, as the US dollar is no longer guaranteed to be the medium for transactions. For the US, this means that its ability to print money at will without immediate consequences will be severely diminished. The Federal Reserve will no longer have the same degree of control over the global financial system, and the US will likely face increased borrowing costs and inflation as the dollar loses its status. The rise of central bank digital currencies, CBDCs, as the global financial system moves away from the dollar. Central banks are exploring new ways to maintain control over monetary policy. One of the most significant developments in recent years has been the rise of central bank digital currencies, CBDCs. These digital currencies are being developed by governments around the world as a way to digitize national currencies and maintain control over the financial system. CBDCs represent a major shift in how money is created and managed. Unlike traditional cryptocurrencies like Bitcoin or Ethereum, which are decentralized and independent of government control, CBDCs are issued and regulated by central banks. This gives governments unprecedented power over the money supply and allows them to monitor and control every transaction within their economy. While CBDCs offer some potential benefits such as faster, cheaper, and more efficient payments, they also raise serious concerns about privacy and financial freedom. With CBDCs, governments could track every transaction and impose restrictions on spending. For example, central banks could limit the amount of money that individuals or businesses can spend on certain goods or services. This level of control could represent a serious threat to personal privacy and financial autonomy. CBDCs could play a central role in the upcoming reset of the financial system. They represent a new form of currency, one that is entirely digital and controlled by the state. As the dollar loses its dominance, central banks may turn to CBDCs as a way to maintain control over the financial system. This would mark the end of the era of fiat currencies and the beginning of a new digital financial order. The coming financial reset and gold's central role. As we approach 2026, it's clear that we are on the verge of a significant financial transformation. The debt-driven monetary system that has been in place since the 1970s is nearing its breaking point. The global financial system is burdened by unsustainable debt, and inflation is rising to levels not seen in decades. As governments and central banks scramble to stabilize the situation, the financial system is poised for another reset. Gold, as always, will play a central role in this reset. As the dollar loses value and global confidence in fiat currencies wanes, gold will emerge as the ultimate store of value. Central banks are already positioning themselves by stockpiling gold, and individual investors are following suit. In 2026, gold could easily surpass its previous highs, potentially reaching $10,000 per ounce or more as the global economy grapples with the consequences of the debt crisis. For those who understand the cyclical nature of the financial system, this is not a time to panic, it's a time to prepare. The coming reset will be painful for many, but it also represents an opportunity for those who recognize the signals. The choices you make today, whether to hold fiat currencies or real, tangible assets like gold, will determine your financial future. Conclusion: positioning yourself for the future. The next decade will be marked by uncertainty and volatility. The 2026 reset is fast approaching, and the consequences of the debt crisis will reverberate throughout the global economy. But amid the turmoil, there is an opportunity to protect and even grow your wealth. Gold has proven time and time again to be a safe haven during periods of financial instability. As the value of the dollar continues to erode, gold will rise. Central banks are already positioning themselves for this transformation, and now is the time for you to do the same. Positioning yourself for the coming financial reset. A guide for wealth preservation. As we near the pivotal year of 2026, the global financial system is on the cusp of a major transformation. The signs are everywhere. The unmanageable debt, the rising inflation, the growing wealth inequality, and the increasing shift away from the US dollar. These are all indicators of a coming reset. As discussed in parts 1 and 2, gold and other tangible assets have historically provided a safe haven in times of financial instability, and this time will be no different. The key question is, how can you position yourself now to protect your wealth and take advantage of the coming financial transformation? In this part, we will explore how to prepare for the inevitable financial reset. We will discuss the key strategies you can implement today to protect your wealth and ensure that you are on the right side of the coming wealth transfer. With careful planning and an understanding of the broader economic trends, you can safeguard your future and even benefit from the coming shift in the global financial system. The role of hard assets in times of crisis. As we approach 2026, one thing is clear. Paper money and debt-driven financial systems are losing their value. The US dollar, which has been the world's reserve currency for decades, is no longer guaranteed to hold its purchasing power. In fact, the dollar's devaluation is one of the most significant risks to financial security in the coming years. Governments and central banks will likely print more money to deal with their debt, but this will only further erode the value of fiat currencies. For anyone looking to protect their wealth, hard assets are the best option. Hard assets, such as gold, silver, real estate, and commodities, hold intrinsic value that is not subject to the whims of central bank policy. These assets have always retained their value during times of crisis, and are likely to do so again in the coming reset. Gold. The ultimate safe haven. Gold has been the ultimate store of value for thousands of years. It has weathered financial crises, wars, and economic depressions, proving time and time again that it can retain its value when paper currencies fail. As the US dollar loses value and inflation rises, the demand for gold will only increase. Investors will flock to gold as a hedge against the devaluation of fiat money, and central banks will continue to build their gold reserves. In fact, we are already seeing this trend unfold. According to the World Gold Council, central banks purchased more gold in 2022 and 2023 than at any time since 1967. This unprecedented level of gold buying indicates that central banks are preparing for a future where gold plays a central role in the financial system. For individual investors, this is an opportunity to diversify away from fiat currencies and into gold. Gold is a tangible asset that cannot be printed or inflated away, making it an ideal hedge against rising inflation and a collapsing currency. Gold is also a portable asset, which means it can be easily stored and transported. Whether you choose to invest in gold bullion, gold coins, or gold-backed ETFs, owning gold will allow you to preserve your wealth as the dollar continues to weaken. Silver, the affordable hedge. While gold is often considered the premier asset for wealth preservation, silver is also a valuable hedge against economic instability. Silver has historically followed the price movements of gold, often outperforming gold during periods of economic turmoil. However, silver has the added benefit of being more affordable than gold, making it an accessible option for a wider range of investors. Silver is widely used in industrial applications, particularly in technology, energy, and manufacturing. This gives silver an intrinsic value that goes beyond its role as a store of wealth. As the global economy transitions, silver could become an even more valuable asset, especially if inflation continues to rise and the demand for commodities grows. Investing in silver coins, bars, or silver mining stocks can provide exposure to this precious metal. While silver tends to be more volatile than gold, its potential for growth during times of crisis makes it a worthy consideration for those looking to diversify their portfolios. Real estate, a tangible asset for wealth preservation. While precious metals like gold and silver are essential for wealth preservation, real estate is another critical asset to consider in the coming financial reset. Real estate has been a reliable store of value for centuries, and it will likely continue to be so in the years ahead. As inflation drives up the cost of living and fiat currencies lose value, real estate prices will rise in tandem. Real estate is a tangible asset that provides both value appreciation and income generation. One of the key advantages of real estate is its ability to generate passive income through rental properties. As inflation rises, so do rents, which means that real estate can provide a hedge against rising costs while also generating cash flow. Owning real estate allows you to protect your wealth from the inflationary pressures that are set to continue in the coming years. Investing in residential properties, commercial real estate, or real estate investment trusts, REITs, can provide a stable and profitable way to protect your wealth. Real estate also provides a level of security that paper assets simply cannot match. Whether you're looking to buy a home, invest in rental properties, or explore commercial real estate, the key is to secure your position in a tangible asset that will hold its value. The case for commodities, a diversification strategy. Commodities are another class of assets that can protect against inflation and currency devaluation. Commodities such as oil, natural gas, agriculture, and metals have intrinsic value, and their prices tend to rise when inflationary pressures are high. As the global economy becomes increasingly unstable, commodities will play a central role in preserving wealth and generating returns. Commodities are typically viewed as a short-term hedge against inflation. However, in the long term, commodities can be a powerful way to diversify your portfolio and ensure your wealth is not tied to one specific asset class. Investing in commodities can be done through direct purchases, such as buying physical oil, agricultural products or metals, commodity futures, or commodity-based ETFs. Diversifying into a range of commodities, such as precious metals, energy, and agricultural products, can provide protection from economic volatility and offer growth potential in uncertain times. Shifting away from paper assets, stocks, bonds, and cash. As we prepare for the financial reset, one of the most important steps you can take is to move away from paper assets such as stocks, bonds, and cash. These assets are directly tied to the performance of the US dollar and are vulnerable to the inflationary pressures that will be unleashed in the coming years. Stocks, a volatile option in uncertain times. While stocks may continue to see gains in the short term, they are subject to significant risk during times of financial upheaval. In a market where inflation is high and debt is unmanageable, the value of stocks can fluctuate wildly. U.S. stock markets in particular are highly sensitive to interest rates. And as interest rates rise to combat inflation, stock prices could see significant declines. While certain sectors such as technology or energy may continue to perform well, stocks as a whole are not a reliable store of value during periods of inflation and currency devaluation. Investors looking to preserve wealth should consider reducing their exposure to stocks and focusing on hard assets. Bonds, a risky bet in a rising rate environment. Bonds are another traditional asset class that faces significant risks in the coming financial reset. As inflation rises and interest rates increase, bond prices typically fall. This makes bonds a poor choice for investors seeking wealth preservation. Long-term bonds, in particular, will likely lose value as inflation increases and central banks raise interest rates to control inflation. Additionally, the growing debt burden in the U.S. may put additional pressure on bond markets, as government bonds may become less reliable if the U.S. is forced to default or restructure its debt. Cash. Losing value in an inflationary environment. Cash, traditionally seen as a safe asset, is rapidly losing its value in the current economic environment. As inflation accelerates, the purchasing power of cash decreases. While holding cash may offer some short-term liquidity, it's an inefficient long-term strategy for wealth preservation. Inflation is the silent killer of wealth, and holding large amounts of cash during a period of rising inflation will result in a significant erosion of your wealth. As the dollar weakens and prices rise, cash will lose its ability to maintain value. Investing in real assets, such as gold, silver, and real estate, is the best way to preserve wealth in an inflationary environment. Understanding the reset, the road ahead, the financial reset of 2026, is not just a possibility. It is an inevitability. The debt-driven system that has fueled the global economy for decades is unsustainable, and the consequences of this unsustainable debt load are becoming clear. Inflation is rising, the dollar is weakening, and the global financial system is on the brink of transformation. For those who understand the cyclical nature of the financial system, the reset offers an opportunity to position themselves on the right side of the wealth transfer. By diversifying into gold, silver, real estate, and commodities, you can protect your wealth and ensure that you are not left vulnerable to the collapse of the dollar system. The next decade will be one of significant financial turbulence. But for those who are prepared, it will also be a time of tremendous opportunity. The wealth transfer from the unprepared to the prepared will be the largest in human history. The question is, will you be ready? As 2026 approaches, the time to act is now. The financial reset is coming, and those who position themselves correctly will thrive in the new global financial order. The key is to take action today, move away from paper assets, diversify into hard assets, and prepare for the future. Navigating the financial reset. Key steps for preserving and growing your wealth. As we stand on the edge of the greatest financial transformation in modern history, the question is no longer whether a reset will occur, but when it will happen and how we can navigate it. The debt-driven monetary system, inflationary pressures, and the devaluation of the US dollar have created an environment ripe for another financial collapse. This reset, however, offers those who are prepared an opportunity to not only preserve their wealth, but to grow it during turbulent times. 2026 is just around the corner, and the coming financial reset will likely be one of the most significant events of the 21st century. This reset will mark the transition from a debt-driven financial system to one based on hard assets, primarily gold, silver, and real estate. Those who position themselves correctly will emerge from this crisis stronger than ever, while those who fail to recognize the signs will see their wealth wiped out by inflation and the collapse of fiat currencies. This final part of our discussion will outline the practical steps you can take today to safeguard your financial future. We will cover how to strategically allocate your investments, which assets to prioritize, and the broader mindset needed to thrive during this unprecedented period of financial upheaval. Understanding the need for a shift. Why the reset is inevitable. The first step in preparing for the coming financial reset is understanding why it is inevitable. The current global financial system is built on a mountain of sovereign debt, and the economic expansion, driven by cheap credit and low interest rates, has run its course. The U.S. government, in particular, has accumulated over $38 trillion in debt, and the cost of servicing this debt is growing exponentially. As interest rates rise to combat inflation, the cost of paying off this debt becomes increasingly difficult. The government is already spending more on interest payments than it does on essential services like defense, healthcare, and education. This situation is unsustainable, and the only way to deal with it is either through default, which would create chaos in the global economy, or through inflation, which dilutes the value of the dollar and transfers wealth from savers to debtors. The global financial system is also facing a crisis of confidence. The US dollar, once the world's reserve currency, is being replaced by alternative assets like gold, silver, and cryptocurrencies. Countries like China, Russia, and India are reducing their reliance on the dollar and turning to tangible assets to protect their wealth. Central banks around the world are buying gold at unprecedented rates, signaling a massive shift away from the dollar. As the dollar's value continues to erode, the stage is set for a financial reset. Governments and central banks will need to implement drastic measures to stabilize the economy, and these measures will have significant consequences for those holding paper assets like stocks, bonds, and cash. Key steps to protect your wealth. 1. Diversify into real assets. One of the most important steps you can take to protect your wealth during the reset is to diversify into real assets, those that have intrinsic value and are not dependent on the performance of the financial system or government policy. The most reliable real assets are gold, silver, and real estate. Gold and silver. These precious metals have served as stores of value for thousands of years. Unlike paper currencies, which can be inflated or manipulated, Gold and silver have intrinsic value and are not subject to the same risks. As the dollar loses value, gold and silver will rise, preserving your purchasing power. Gold, in particular, is likely to see significant gains as central banks and investors flock to it for safety. The price of gold could easily surpass its previous high of $1,921 per ounce in 2011, and even approach $10,000 per ounce or more in the coming years. Silver, though more volatile, will likely follow gold's lead and could see a similar surge in price. Real estate. Real estate has always been a tangible asset that appreciates over time, especially during periods of inflation. As the cost of living rises, the value of real estate will increase. Residential properties, commercial real estate, and even real estate investment trusts, REITs, can be great hedges against inflation. Real estate not only offers potential for price appreciation, but can also generate passive income through rental properties. Investing in real estate in regions where demand is expected to grow can provide both capital gains and cash flow. Look for opportunities in areas with strong job markets, infrastructure development, and long-term growth potential. 2. Invest in gold and silver mining stocks. While physical gold and silver are essential for wealth preservation, another way to capitalize on the rising prices of these metals is through mining stocks. Companies that mine gold and silver stand to benefit directly from the increasing demand for these metals. Gold and silver mining stocks. These stocks tend to outperform the metals themselves in times of crisis, as mining companies can generate massive profits when the price of gold and silver rises. Many mining companies are undervalued, especially in the current market, and investing in them can provide significant upside potential as the price of gold and silver rises. Look for companies with solid balance sheets, strong management teams, and proven track records of profitable operations. Additionally, some mining stocks pay dividends, providing a potential income stream in addition to capital gains. Exchange-traded funds, ETFs. If you prefer a more passive investment strategy, you can invest in gold and silver ETFs. These funds track the price of gold and silver and offer exposure to these precious metals without the need to physically own them. ETFs like SPDR Gold Shares GLD or iShares Silver Trust SLV are popular choices for investors looking to diversify their portfolios. 3. Invest in real estate with focus on inflation-proof sectors. Real estate has always been a solid investment, but as we face a financial reset, it's crucial to focus on the sectors that are most likely to benefit from the ongoing economic turbulence. Residential real estate. As inflation rises, the demand for housing will increase, particularly in areas with strong job markets and desirable living conditions. Investing in residential properties in high-demand areas can provide steady rental income and significant price appreciation. Commercial real estate. While some commercial sectors may struggle during a recession, others, such as industrial properties, warehousing, and logistics centers, are poised to thrive. The e-commerce boom has driven demand for industrial real estate, and the trend is expected to continue. Additionally, multifamily housing can be a great way to generate income as rents rise. Many investors are flocking to real estate crowdfunding platforms and REITs, which allow you to invest in large-scale commercial or residential real estate projects without the need for direct ownership. 4. Consider cryptocurrencies as a long-term hedge. While cryptocurrencies are a relatively new asset class, they are becoming an increasingly attractive option for investors looking to hedge against inflation and currency devaluation. Cryptocurrencies like Bitcoin and Ethereum have gained significant traction as alternative stores of value and means of exchange. Bitcoin, often referred to as digital gold. Bitcoin has a limited supply of 21 million coins, making it a deflationary asset in contrast to fiat currencies, which can be printed in unlimited quantities. Bitcoin has the potential to appreciate in value significantly as people lose faith in the dollar and other fiat currencies. While Bitcoin remains volatile, it has proven its resilience in the face of economic uncertainty and has been embraced by institutions and central banks as a store of value. As we move toward a digital economy, Bitcoin and other cryptocurrencies could play an increasingly important role. Ethereum, the second largest cryptocurrency by market capitalization, has become a major player in the world of decentralized finance, DeFi, and smart contracts. Ethereum's underlying blockchain technology has numerous applications beyond just being a store of value, and its long-term growth potential could be significant. Investing in cryptocurrencies should be done with caution, as the market remains highly volatile. However, with the right strategy and risk management, cryptocurrencies can provide a diversification tool to hedge against traditional market risk. 5. Reduce exposure to paper assets. As we prepare for the financial reset, it's critical to reduce exposure to paper assets, such as stocks, bonds, and cash, which are all vulnerable to inflation and the collapse of the fiat system. Stocks. While stocks can offer growth potential, they are tied to the performance of the broader economy, which is facing significant challenges in the coming years. The stock market is likely to experience significant volatility as inflation rises, interest rates increase, and the dollar weakens. Reducing your exposure to stocks, particularly those in sectors vulnerable to inflationary pressures, is a prudent move. Bonds. Bonds are traditionally considered a safer investment, but as interest rates rise to combat inflation, the value of bonds will likely fall. Long-term bonds, especially government bonds, may lose value as the cost of servicing debt rises. Bondholders will be at risk of negative real returns as inflation outpaces the yield on bonds. Cash. Holding large amounts of cash is a losing strategy in an inflationary environment. As inflation accelerates, the purchasing power of cash will erode. Cash is a temporary store value and its purchasing power will decline over time as prices rise. Mindset for success. Preparing for the reset, while practical steps are important, the mindset you adopt during this period is just as critical. Preparing for the financial reset requires more than just financial knowledge. It requires a mental shift from passive wealth accumulation to active wealth preservation. Patience. The financial reset will not happen overnight. It may take several years for the full consequences of the reset to unfold. Patience is crucial as you ride out the volatility of the reset and focus on the long-term potential of real assets. Diversification. As the global financial system resets, it's important to diversify your investments. Relying too heavily on one asset class, whether it's gold, real estate, or cryptocurrencies, can expose you to unnecessary risks. A balanced portfolio that includes multiple asset classes will provide protection from different types of financial shocks. Awareness. Keep an eye on economic indicators, government policies, and global financial trends. Staying informed about the developments in the global economy will allow you to adjust your strategy as necessary and take advantage of new opportunities. Conclusion. The wealth transfer is coming. Are you ready? The next decade will be filled with unprecedented challenges and opportunities. As we approach 2026, the financial system is on the brink of a major reset. The coming reset will create the largest wealth transfer in human history, as those who are prepared will prosper while those who fail to recognize the signs will suffer. By diversifying into real assets like gold, silver, real estate, and cryptocurrencies, you can protect your wealth and even grow it during this period of financial turbulence. Reducing exposure to paper assets and focusing on hard assets is the key to navigating the reset. The wealth transfer is coming. The question is, will you be ready? The choices you make today will determine your financial future. The reset is inevitable, but with the right strategy, you can emerge from it stronger and wealthier than ever.